Hello and welcome to another episode of Darwin Investors. Today I'm going to talk about how we can play this market in this time. You don't see the big banks complaining about the fact that they're losing money at this time because they're not. And you will never see me putting out videos about how I'm losing money at this time because I'm not, because I'm playing the same exact game they're playing. And I'm going to show you how to play the same game that we are all playing, those of us that are making the money. So a couple of weeks ago, I put out a video that showed how I thought that the Federal Reserve would come out and they would have some sort of monetary policy shifts that was going to spook the market. And so I decided to push my portfolio into more of these low PE, high valuation stocks, and then sell covered calls and cash secured puts against these positions. And that's exactly what they're doing as well. I'm making money, they're making money, and provided you're not too greedy, I can show you how you can make money as well. So sit back and watch the rest. Make sure you get to the end because I'm going to that's like the money ball. I'll show you exactly the way it's done at the very end. So let me show you my screen here. So Lowe's is a company that I got into, and I thought, well, here is a good company to get into. It's got a relatively low PE. It's got a dividend yield. It's a good stock. And so this was a company that had been trading up here next to its resistance. So if I look over here at the resistance of Lowe's, I would say it had a resistance of 262 and a support of 245, right? And so at the time I was selling covered calls at about this time when they're about 258, 259, saying that they will not break resistance, not without some sort of catalyst. And so I'm basically trying to make money on this stock as it drops. I love Lowe's. I think it's a great company. It's a duopoly. It's not going anywhere. Does anybody really think Lowe's is going anywhere? No, we don't. And it pays a dividend. And now I'm going to collect a different dividend off of it. So what I did on Lowe's was let's see here. This is from December 31st until January 8th, was I was selling covered calls. Now it's very important that you understand this because this is how they're making money. Okay, they're depending on your greed. So let's just go ahead and make sure that you understand this. So on December 31st, I sold a covered call on Lowe's with a strike price of $262.50, meaning that if it finishes at $263, I will have to sell 100 shares because it was one contract. I will have to sell 100 shares of Lowe's at $262.50, even though the price is $263. Now, the expiration date was yesterday, would have been January 7th. And the strike price was $99.35. Actually, it was $100, but it's $99.35 after Charles Schwab takes their cut. And so, basically, I sold this covered call and I bought it back for $28.65. It netted me about $70. Okay, so why would I not just wait for it to end? Well, the reason is because I can sell it again, right? So once you've made a good percentage of your covered call money back, and in this case, it'd be like 70%, just buy it back on a covered call. Okay, it's different from cash secured put. On a covered call, buy it back, because if the stock dives, you can do it all over again. You sell it when it dives, and then when it goes back up, you buy it back again. And again, you look at Lowe's, and this would have been on the 6th of January. I sold a covered call for $262.50 that expires next Friday. And I sold that for $145.35 or $146 before Schwab takes their piece. But Lowe's took a dive, as did most of the market. So this was my hedge against an equity that I like. Do I care really if Lowe's goes down? Do I really think Lowe's will never come back? Do I really think that I've lost this unrealized gains on Lowe's? Of course not. That's ludicrous, right? And so I know eventually if I wait, I don't care if it's a year, 2 years, 3 years, I know Lowe's will eventually be worth $262.50. This I know, right? So what I'm trying to do in the meantime is make some money against this position while it goes down. And I'll tell you who else knows this. Big banks know this. They're not worried about it either, right? And so I sold a covered call that expired on January 14th for $145.35. I bought it back. Let's see, I sold it on the 6th and bought it back on the 7th for $40. So in this case, I made about $105. So in a week on lows, I still own my shares. I made $175 and I have unrealized losses that I don't give a dang about, right? Not only did I do that on lows, I did this on Visa. Let's see what I made on Visa. I'm not exactly sure. Okay, I only did it to Visa one time. So Visa, I sold it a covered call on Visa on the 6th, which was, I guess, Thursday, with a strike price of $227.50 that expires next Friday, the 14th of January, and I sold it for $116.35. And then Visa went down, and because Visa went down, it put my covered call more in the money. And to buy it back, I only need to pay $34.65. And there may be some of you out there that might think, well, why would you buy it back at all? Just let it run to the end. No, I'm not going to do that because Visa could have an amazing day on Monday, get up to $225, and I'll sell this thing again. And I'll make the same money. Because when I look at Visa, I see a stock that's not really going to break, let's say, $230. Let's see here. This is the resistance is 222. I sold it for 227. Let's go back to this here. Best case scenario, I'm thinking 233. So if I sell this thing just out of reach, let's say it runs to 230, which would be best case scenario, I could sell it for 235, right? A covered call against that position and make more money next week. And that's exactly what I plan to do if Visa runs next week. Again, it's Visa. Do I really think Visa is going away anytime soon? No, I don't. Does anybody that watches this channel think that? No, they don't either. How are you going to pay for your lunch tomorrow if you go out and do that? You're going to break out your credit card, and on that thing, your ATM card is going to say Visa. We're all using Visa. We know they're going nowhere. So this is the way that the banks are making money as well. But to illustrate this point even better, let me show you what they're doing as a way to make money against people using NVIDIA. And NVIDIA is like, I mean, that is my favorite stock. I think that I'll do a video about NVIDIA, but it is simply my favorite stock. And so NVIDIA was a little bit different, and let me show you exactly how they're making money. They're using the covered call strategy against you, and they're using your greed against you. Now, let me show you how this works. So selling a put is different from selling a covered call. When you sell a put, you're basically saying, somebody else is saying it's going to finish lower than $275, right? And if it finishes at 274, if you sell a put, it means you have to buy 100 shares in this case, one contract, for $275 a share. So if it finishes at 274, I still have to buy it for 275. And someone will pay me, in this case, it was this was all done yesterday. And someone paid me $259 or $260 to make this bet. What they're saying is that for 275, that they believe, in order for them to give me 260 for this, is that they believe that this stock will actually fall between $272.60, right? Is that right? $260.40 actually, $272.40, excuse me. So they think it's going to finish below $272.40. That's why they would give me this much money in one day. And so I decided before they had a chance to realize their gains, I would get them. And I wasn't going to be too greedy. I was pretty greedy. I made about $110 in this exchange yesterday, right? So I bought it back because the key is, why would you not wait until the end of the day and make all 260? Well, that's what the banks are counting on. They want you to wait, make this 260 and buy their shares for $275 a piece. That's what they want, okay? But I bought it back, and then I sold it again later on in the day, this time with a strike price of 272.50. It expires yesterday. So I sold it yesterday, expires yesterday, and I sold it with a strike of 272.50. If it falls below 272.50, I have to buy 100 shares of NVIDIA at 272.50, right? And somebody said they will give me $72.35 to make this agreement. Well, I went and I bought it back for $18.65, right? And so I made about $50 on this exchange saying, you know what, I'm good, I'm out, I don't need the extra $18. But this is what screws the banks. And I'm going to show you how to do it, is you got to be happy in these situations with small gains when you're selling puts. Because here's what happened to NVIDIA yesterday. So just to recap, there's covered calls and there's selling puts. And I said I would buy this 100 shares if it finishes below 272.50. Well, you tell me, is this a coincidence? 272.47. I'm sitting here at what looks like 3:50 p.m., probably thinking that I'm okay, right? Let's say that you've sold this put and you're thinking, well, that's okay, I'm going to get all $72. And in the next 10 minutes, wham, they stick you with the shares, right? Because you were too greedy and you didn't get out, and they're counting on your greed, so they'll unload the shares on you, right? They're counting on it. But what they have done for their end is they have sold covered calls against this position. Probably when it was clear the heck up here at 281, they said, we're going to sell a covered call against this position for 272.50. So they're getting a gigantic premium, because right now, if they sell it, if it's a 280, we'll say, and they sell it for 272.50, it's $7.50 in the money, meaning they're already making $750 per contract on what's called intrinsic value at the time they're selling this thing to you. And they know they're going to drive the price down so they can keep their shares and your money. And they don't give a crap about what the price of this stock is. All they know is they want it to finish below that, but not too much below that, so they can keep their money. So what I'm trying to tell you to do is how you can get back at them before they get to you. And the way you can do that, and you'll never get the same exact thing that they're going to get, because you're never going to, I mean, if you get lucky, maybe you'll sell a covered call when it's sitting at 280 for 272.50, but they know that that's what the price is going to be on Friday at close. We can't know this, but all we can know, and the things we can control, is that we can take our little gains where we can get it. And that's what I've been doing. And so that's the way to make money in this market. You got to get quality stocks that you don't care if the price goes up or down, because you know that the prices, if it goes up, you don't get too high because you know it's going to go down. If it goes down, you don't get too low because you know it's going to go back up. And then on these equities, you go ahead and sell covered calls if they're near resistance, and you sell puts if they're near support. And that's the way to make money on this market. Now, the ones who you're selling covered calls on, you don't care if you let it run too much because you're still going to make money. But if you're going to sell puts near support, make dang sure you get out of it with some cash, because believe me, they're going to try and stick you with those shares. If you got anything out of this video, please like and subscribe, hit the little notification bell, and until next time, we'll see you.